Good afternoon, everyone. My name is Kyle Brown. I'm a senior account manager here with JWB Real Estate Capital, and we're very happy and excited and thankful that you took some time out of your busy schedule to learn a little bit more about something that we are very passionate about here at JWB, which is the Jacksonville real estate market. So today we have our president, Alex Safakis, on the call with us.
Hey, how's it going, guys? Appreciate you having me. What's up, Kyle?
Hey, Alex, how are you?
I'm pretty good.
So Alex, as you all know, is one of the founders of JWB, and he's also a respected national real estate expert, and we're lucky to have him on the call here with us. Over the last 6 months, Alex has been quoted, and JWB has been featured in the Wall Street Journal, the New York Times, Bloomberg, Florida Trend, as well as the Jacksonville Business Journal. So a lot of publication for Alex and for JWB, and really over the last 8 years, JWB has been helping investors all across the world passively invest in real estate within the Jacksonville market. We are a completely full-service real estate investment company, and we take care of all the headaches and all the minutia involved in real estate investing for our clients so they can sit back, earn great returns in real estate, and enjoy their life. With over 1,000 properties purchased in the last 8 years, JWB truly has a track record that speaks for itself. So if at any time during or after today's webinar you have questions, comments, or decide you would like more information about how JWB can help you passively invest in real estate in the Jacksonville market, you have two options, which I've just put up on the screen. You can email us at info@jwbcompanies.com, or you can call us at 904-677-6777. Also, we will be recording a copy of this webinar, so if you'd like a copy of it to listen to at a later date, please email or call us and we'll be happy to make sure you get a copy. All right, so without further ado, I'm going to turn it over to our president, Alex Safakis, to give everyone some great insight into the metrics that JWB tracks in order to help us understand the real estate market and what's been happening in Jacksonville. So Alex, take it away.
Thanks, Kyle. Appreciate the intro. Yeah. Once again, I'd like to thank all you guys for getting on the call today. I'm going to jump right into the info because we have a lot to go over in a short amount of time. All right. So here is our agenda for the call today. First, we're going to go over the purpose for all this data tracking that we're doing here at JWB. There's got to be a reason for what we do, and we're going to go over that. Then I'm going to give an overview of the two main types of metrics that we track that help us better understand what is going on in the market. Then we're going to talk about three foundational concepts that you really need to understand, and I'm going to help you guys understand, that really help us relate to and understand the data that we're looking at. And we're going to wrap up the call by actually looking at those Jacksonville metrics, going through the data, so we can explain to you guys what we see going on in the Jacksonville market and what we might be able to expect going forward. I do need to point out that no data is perfect, and obviously no prediction of the future is either. All right. So the reason that we do all this data tracking is because as we see it, there's really three states of the market. You have the market as it was, the market as it is, and the market as it will be. Now, of course, the most valuable information here is number three, the market as it will be. And what we're doing is we want to track number one and number two, market as it was and as it is, in order to try to predict number three and get that valuable information. So, going over the two main metrics that we track, which are our inventory levels and pricing. And I'd like to talk about inventory levels first. So, inventory levels tell us the current demand for houses in the market, and if you track it by month, will tell you historical demand as well. It is defined and tracked as months of inventory, or MOI for short. And it's a number, and a lower number signals higher demand. The formula to figure out of of inventory is pretty simple. It's the number of active listings, which is the number of properties that are currently listed on the market for sale, divided by the number of houses that have sold in the past month. So if you looked at it, if in the month of February there was 8,000 properties listed and 1,000 properties sold in the month of February, that would be 8 months of inventory. So what this months of inventory tells you is it tells you how many months it would take for the market to run out of inventory if no new homes were added to the market and home sales continued at the current pace. In equilibrium market, so a normal market that balanced between buyers and sellers, has between 6 and 7 months of inventory. So if a market has less than 6 or 7 months of inventory, let's say 4 or 5, that would be what is defined as a seller's market, where it's easier, because there's less inventory in the market, it's easier for sellers to get the price they're asking for. And if there's more than 6 or 7 months of inventory, that would be described as a buyer's market. And if there is 6 to 7 months of inventory, that's an equilibrium market. The best part about inventory as a metric is that it is a very, very good predictor of price increases or decreases going forward. So if inventory is at that 6 to 7 month range, you can expect normal home price appreciation. Now for Jacksonville, normal home price appreciation is right around 4%. We'll talk about that a little bit more later. If inventory dips below that 6 to 7 month range, you can expect higher than normal price appreciation.
And Alex, correct me if I'm wrong, but we've seen some drastic swings in inventory levels over the past couple of years. I know in 2005 we were looking at about 5 months of inventory. If you looked at 2009, there was 18 to 20 months. And then early last year is back to 5 months again. Is that right?
Yeah, that's exactly right. Inventory has fluctuated drastically over the past couple of years, and it's very, very indicative of future price increases or decreases, and we can look back and historically see that this is true. So in 2005, when inventory was low, prices were on the upswing and they continued to rise. In 2007, 8, and 9, inventory levels were extremely high. At some levels that really hadn't been seen before, 18, 19, 20 months of inventory. And obviously the prices fell after that inventory went up. So it very closely correlates with price increases or decreases, as we're going to see when we look at pricing. And pricing is the next metric that we are tracking. So we track the median home price as opposed to the average, because averages are more easily swayed by outliers. And the median home price is the middle price. So if you have a data set of 101 data points, 101 houses sold, that 50th data point is going to be the median. So it might be different information that you've seen elsewhere, this pricing information we're going to be going over, but we feel that this information is a very good representation of the housing stock that we're interested in JWB. Because what we do is we actually take out condo sales. So we only do single-family housing sales, which is primarily the housing stock that we look at JWB. And as you can see on the second point there, we track it by month, and we track a couple different variations of it. We're using different filters to only track it by REO, only track it by short sale, only track it by non-distressed sales. So that will help us give a lot better insight into the market and can be very helpful at times when the macro information, the overall median home price information, is confusing or not what we'd expect, which actually happened in January, as I'll show you in a little bit.
And aren't these sale prices, Alex, or these are coming straight from the MLS, right?
Correct. All of the data that we'll be going over here today comes straight out of the multiple listing service, which is the central database that all realtors list and sell properties with. So it's very reliable information. Good. Yeah. All right. So now I'd like to go over these 3 foundational concepts that help us to really understand this information. So without knowing these 3 concepts, some of this information can be misleading. And the first one is seasonality. So seasonality describes the phenomenon that more people buy houses during the summer. There's a number of reasons for this. that school is out, families can move without disrupting the kids, the weather's nicer, spring cleaning. People can debate all the reasons why. What can't be debated is that it happens and that it affects prices. Since more people buy houses in the summer, that means demand goes up in the summer, and which means prices go up and inventory levels go down. In the winter, of course, the opposite happens. Demand goes down, prices go down, and inventory goes up. Over the last 14 years, the average price swing from June of the prior year to January of the current year was 10.94%. That is a large price swing. So as you can see here, here's a graph showing that seasonality. And it's the price difference is from June, which is the red line, to January of the following year. So you have home price here in June of 2001, and it fell to January of 2002. The following year, it obviously went up in June, prices go up in summer, and then fell in the winter. The only year where this wasn't true was June 2004 until January 2005. Every other year, the past 14 years in this data set, this is proven to be true. And in Jacksonville, the difference between the price in June and the price in the following January, on average, is 10.94%. It's very powerful when you're looking at data and comparing from month to month.
And Alec, this is true across the country, right? Not just in Jacksonville, this phenomenon?
Right. It's 100% true across the country, and it actually has even more of an impact in the northern states, where obviously it would seem logical that the stronger winters would contribute to that. But you can actually use this. If you can wait to buy a house, you can get a better deal on the house if you buy it in the winter.
So if you can stand to go out in the cold, you get a better deal.
You can get a better deal buying it in the winter. Absolutely. So the second concept that we're going to talk about is the historically appreciated median home price. So this is a concept that can be used to approximate where housing prices should be, assuming that, one, you have a starting price point that was representative of an equilibrium market, and two, that you're holding an appreciation rate constant for what a market should appreciate for. So putting this into practice, we're going to use the first data point of January 2001 as an equilibrium market. If we look back in history, it actually was. There was between 6 and 7 months of inventory, and home price appreciation hadn't yet taken off. So in January in 2001, median home price in Jacksonville was $111,900. Now, the historical appreciation rate for Jacksonville from the previous 20 years, which we're going to use to say is normal home price appreciation for Jacksonville. If you take a period of 20 years, you're normally going to have some recessions and some expansions, and overall you should get a pretty good appreciation rate that's indicative of the market. So using these two data points, we can extrapolate out and take the home price, the median home price in January 2001 at $112,000 approximately, and appreciate at 3.8% per year, and we come up with this line. So down here at the bottom, we have the median home price of $112,000 in January 2001, and then you appreciate it at 3.8% per year, which showing that currently in January 2014, median home price should be somewhere around $182,000 if we're holding those two assumptions as valid. Now, of course, did home prices really follow this nice even line here?
Looks like a smooth ride.
Yeah, it's been totally a smooth ride the past 14 years. Right? No, of course not. So here's what really happened. So prices started taking off right around 02, 03, went way high to a median home price of $223,000 in June of 2006. Due to, obviously some unsustainable lending practices that just created crazy demand, even though people couldn't pay for their houses. And then the market crash happened, where prices fell. And you can actually see the seasonality here, where prices would fall in the winter and raise back up again in the summer, and fall and raise back up. But overall, the trend was very negative, all the way down to January of 2012, and you can see it crosses over the long-term trend line here. And in January of 2012, prices started going up and went all the way up to median home price of about $178,000 in July and August of this year. Last year of 2013, before they fell again, some due to seasonality, and then you see them fall off here, which is a data point that we're actually going to look at in depth a little bit more. But so you can see what you would expect is for home prices to come back up to reach that long-term trend line. And something that we know about bubbles, if you look at it at the Dow Jones or when it fell to 6,000 and jumped back up, or gas prices or anything, normally bubbles will overcorrect themselves again and should jump above that long-term trend line. So this just gives a good graphic representation of where home prices actually were and where they should, quote unquote, be if you're holding those two data points constant. Make sense, Kyle?
Yeah,
you got that?
Yeah. It's interesting seeing the seasonality in play and how consistent that is.
Yep. It's pretty crazy. All right, so the last foundational concept I'd like to go over is how the property sales mix affects the home pricing metrics. So I'd just like you guys for now to look at the top part of this slide. So the green box is indicative of a non-distressed house in the example we're going to use, and the red box is indicative of a distressed house. And we're going to show how the makeup of distressed housing to non-distressed housing can greatly change the average and median home price a lot more than real home prices changing. And the example that I'm showing here is just an example. It's not actually indicative of real home prices or of real appreciation. It's just an example that's showing how this property sales mix can affect pricing. So if you look at this example now here where it says 2 years ago, so the top row of houses. 2 years ago in this example, there was one non-distressed house selling for $100,000 for every 3 distressed sales at $50,000, which gave an average home price of $62,500. That was 2 years ago in this example. Like I said, this isn't real data. I'm just using this to show how this sales mix affects home prices. So now, let's say that the price of a non-distressed house has actually appreciated. It's gone up 20% to now $120,000. But also what has happened is the property mix has changed. So there's 3 non-distressed houses selling for every 1 distressed house. And that distressed house also appreciated by 20%. So across the board, each house, really, the real home price appreciation was 20%. But because the mix changed, as you can see, average home price went from $62,500 to $105,000. So the average home price went up $68,000, where real home prices only went up 20%. So the mix of distress versus non-distress, different types, different sizes of houses, can greatly affect the average and median home price. In this example, I used average because median doesn't work that well when you only have 4 data points, and we didn't want to have to extrapolate this out too far to have it make sense.
So basically here you're saying, obviously the more distressed houses that are on the market and mixed into the available inventory can greatly impact the actual sales price.
Can greatly impact the median sales price, even though it might not have as drastic an impact on the real sales price, which we'll see. Of course, a lot of foreclosures will drag the market down, but it doesn't affect the real home price as much as it affects median. So that's just showing the shift. And this is, it's fairly representative of what has actually happened in the last 2 years, where a lot more foreclosures were selling a couple years ago than were in this past year. But like I said, not exactly to what we're showing right here. Awesome. All right, so the last thing I'd like to go over before we actually get into the Jacksonville data is that data is not perfect. Even though this information is what I consider extremely reliable, and we're pulling it from a source such as the MLS, when I went back just this past week and re-pulled this data for the past year, just to double check it, some of the data had changed in the MLS, where realtors were changing or updating things going back in time. So some of it had changed a little bit from even my old historical data. not enough to make an impact on the outcomes that we'll take from the data, but I just want to put this out there. The data is not perfect, and also the assumptions that we're making based on the data are not perfect. Even though inventory is an amazing indicator of future home prices or decreases, you can't take it as 100% fact. You have to use that along with all your other information to make the best judgment about what you think is going to happen. So I just wanted to put that out there as a disclaimer. All right, so let's get right into the data. So here is the months of inventory data for Jacksonville over the past couple of years. So what I did is I put one data point in here in December of 2007 to show where that inventory was a long time ago. And the inventory was actually very high for a number of years. 07, 08, and 09 was extremely high. So if you look at this top row, December 07, there were 16,000 plus properties listed as active on the market, and only 900 properties sold that month for a months of inventory of over 18 months of inventory.
Wow.
Yeah, extremely high. If an equilibrium market is 6 to 7 months, and anything over that is a buyer's market, this was really a buyer's market. As we now know, I mean, there were some extreme bargains available at that point in time. So jumping forward to the past year, you can see in April 2013, so what I did is I pulled a couple of months spread apart from this past year. April 2013, there was just over 7,000 properties listed, 1,750 properties sold for a month of inventory of 4. And then inventory slowly creeped up through July and into November, up to 5 to 6 months of inventory. Now, due to seasonality, we would expect less houses to sell in the winter and for inventory to creep up. So even though that the inventory at 6 to 7 months seems to be at an equilibrium market in the winter, it's actually a positive indicator of future home prices or decreases, because we would expect to see higher than equilibrium inventory in the winter. And as you can see, inventory levels in February are already starting to go back down, which we would expect to see coming into spring now. And I don't know where all you guys, we probably have some New Yorkers on the call, but spring in Jacksonville happens sometime around March. And so you're getting this warm weather, so we're going to start to see that uptick, as we can already clearly see in this months of inventory metric. So what does it mean? So this current months of inventory, what it tells us is that inventory levels, especially once seasonally adjusted, are still very low and at or below an equilibrium market. So this should predict higher than average price appreciation over the coming months. And inventory, because it's tracked on house sales in that current month, it can fluctuate fairly largely from month to month. So this is something that we track, obviously, every single month, and we look at to make sure that there isn't a bunch of properties dumped onto the market, that people aren't stopping buying for some reason, and that the inventory isn't increasing. So it's something that we track, but right now we're very bullish on the numbers because of this low inventory, which historically has been a very good predictor of future price increases. All right, now we're going to look at home prices. So we've already seen this graph earlier, but I'm really going to bring it back up now. So home prices, as we discussed, were at a median high of $223,000 in June of 06, fell all the way down to January 2012, and are now coming back up. And we should expect to see continued price appreciation along that long-term trend line, even go above that line, because we are coming out of a bubble, and normally it will go above that long-term trend line. Now, what we saw here is, the median home price in July of this year, July and August, was around $178,000, and then fell in the winter months to around $160,000, which was to be expected. Now, what wasn't to be expected is this plummet here, where the median home price fell from $160,000 to $136,000 in January, and up to $145,000 in February. This would be a lot larger decrease than what would be normally expected due to seasonality, and could be alarming if you didn't have those other filters and other layers to look at to figure out what was happening, which is, of course, what we did. And assuming that you didn't have this data point here of March. So obviously March to date has jumped back up to the $160,000. Well, let's assume we didn't have that data point. We just saw prices fall in January and February. Well, why did that happen? Let's look a little bit more in depth into the data. So what we would assume, what I assumed, and what turned out to be true, is that that property mix changed. So that third foundational concept comes into play here. So as you can see, in January and February 2014, the median home price was $135,000, a big drop from the $175,000 median in July and August 2013. So what caused that median home price to fall that much, way more than what we would expect due to seasonality? And that property mix shifted. So in January and February, 36% of sales were REOs, where in July and August, only 23% of sales were REOs. So if we're making the assumption that REOs sell for less than non-REO properties, this could have a large impact on the median home price, especially depending on how large that difference is between the REO price and the non-distressed housing price. Kyle, I think there's a big difference between there?
There is, yeah, clearly. So this goes back to the mix, obviously, that you were discussing earlier, because we saw months of inventory. There was not a big change there during this time period. But obviously, there's a big price difference. So it's back to that example of the mix of properties that changed.
Exactly. And how much the price difference will make a big impact on if we believe that that was the real reason why it shifted it that much. And as you can see here, there is a really big price difference between an REO and a non-distressed sale. So the average REO, the median REO in January and February 2014 sold for $74,000, where the median non-distressed sale, which means non-REO or non-short sale, sold for $198,000. So that's a huge difference. So that mix, REOs went from 23% to 36% of the market, which is an increase of around 50%,
right,
which obviously had a big impact on that macro median home price. So just to take it a step farther to make ourselves feel a little bit even more positive that this is what caused that price drop, we went and we pulled out those distressed sales and just looked at non-distressed sales and the median home price of those. So the median home price in January and February 2014 of non-distressed sales, so looking at this part of the graph right now, was $198,000, and the median home price of non-distressed sales July and August 2013 was $215,000. Now that is a difference of 8.6%. And since we know that seasonality can account for somewhere around 11%, this is actually lower than expected depreciation due to seasonality and isn't concerning. So this is just an example of how we check the macro data. We see something that is concerning us that might be indicative of some future event or price increases or decreases, and we dig down into the data to really understand what is going on. And now, well, I already showed you guys, you already saw what happened in March, but now we're looking at what happened in March. So as you can see here, prices in March jump right back up to that $160,000 median price point around, and obviously the data for March isn't totally in yet, but the median home price currently is $163,000. And this has happened even though foreclosures are still making up 34% of the market in March. So in January and February, they were making up 36%, slight decrease to 34% of the market. But the fact that prices have jumped up to $160,000, even though foreclosures are still making up a very large part of the market, is a very good sign. And I broke it out, and non-distressed prices are up to a median home price of $207,000, and REO prices are up to a median price of $85,000. From that 74,000 number. So this is causing this median home price increasing, obviously. And this price growth was somewhat to be expected as spring rolled around and turned into summer and prices go up. But the rate at which prices recovered, despite the continued very high number of REOs, is a great sign that there's still a tremendous amount of demand in the Jacksonville market, and that prices should be up fairly sharply in the summer. So just going back to wrap up the pricing metric summary. So despite the large number of foreclosures entering the market this year, which was to be expected, the banks this year are starting to unload the last of their foreclosure inventory that they've really been holding the past couple of years. Due to prices going up, they feel like they can get higher prices for it now, and they're going to start pushing it through the market, pushing it to the market. Something else that's really interesting that I didn't have time to put on the slide, but short sales are down drastically. Short sales have fallen from about 200 a month in July and August of 2013 to about 80 or 90 a month this year, which shows that banks aren't willing to negotiate and take big discounts on short sales anymore. They feel like they're okay foreclosing to get market value and pushing these things through the system. And I think we're going to see this continue this year. We should see a large number of foreclosures coming out this year. But even so, what we've shown in the data in March, even though foreclosures are going to make up a big part of the market, we still definitely expect prices to increase due to the demand that's out there from both investors and homeowners. So the second part of this that we can take away is it should present a great opportunity for both fixed and flip investors and buy and hold investors. And this is really because the large number of foreclosures that should be coming out of the market this year will present a great buying opportunity for investors to get these distressed properties at a big discount. But the strong demand for properties, and especially non-distressed properties from homeowners, should create significant real home price appreciation, which obviously greatly benefits the buy and hold investor. So overall, we're extremely bullish on the market in Jacksonville. There was actually a study that came out about a week ago that showed that Jacksonville was picked out of all the cities in the country a top 5 market as far as home price appreciation going forward over the next 5 years. So we're predicting Jacksonville to have extremely great home price appreciation over the next 5 years. And experts such as Ivy Zellman and Oliver Chang, who really go-to experts in this space, are all predicting very strong growth over the next 3 to 5 years across the country. And as we can see from these numbers, we expect the same things and even better things in Jacksonville. So that's a real, a fairly in-depth look into the metrics of the Jacksonville real estate market and what's happening and what we see going forward in the future. So just really appreciate you guys getting on the call.
Yeah, thank you, Alex, and that was a ton of great information there. Clearly, Alex is an expert on the Jacksonville market, and we benefit from his expertise, and just appreciate everybody that was able to join on the call today. Hope you were able to take something from this, but clearly, if you have additional questions, would like to chat with us, feel free to email us, info@jwbcompanies.com. You can give us a call at 904-677-6777. We'll be happy to answer any questions, talk with you. You can also get a copy of this webinar if you'd like to have it to listen to again, since there was so much information in there. So anyway, thanks again, Alex, and thank you to everybody that joined us today.
Yep. Thanks for watching, guys. Have a great day.